Hey guys, thanks for stopping by thetradinganalyst.com. This is Taylor. We're going to cover two different things in this video, and here's the list of them. I'm going to start with the fund outflows, range compression, USDJPY versus the S&P 500, and a lot of other things. And I'm going to end the video with just some chart analysis of the current S&P 500 chart. I'm going to show you some bounce zones, some resistance, and what we need to see for either a bullish or a bearish breakout. So you're really going to want to pay attention because we're going to cover a lot of things today. So the first thing we're going to be covering is the fund outflows versus the S&P 500. And first I want to give credit where credit is due. This is Callum Thomas. He's a great researcher, an analyst. You can follow him on StockTwits or Twitter. Here's his StockTwits handle right here, Callum Thomas. Again, I'm not affiliated with him in any way whatsoever. He has no idea that I'm making this video or anything like that. But I am just giving him credit because the next three charts that I'm going to be showing you came from him. So this is the S&P 500 price versus the cumulative fund flows. And what this means is how much cash is being put to work by funds, all right? And as you can see, I'm going to move my face out of the way just a little bit. Okay, so as you can see, right now there's a disconnect between price and fund outflows, all right? We've got fund outflows moving down and price is moving up, all right? Or kind of trading sideways at this point in time, all right? Similarly to how we did over here, all right? This was a little bit bigger of a disconnect just recently. You can see as people right now have a lot of cash on the sidelines. You can see the last time this happened, this led to much higher prices in the stock market. The difference here, and this is what makes what we're seeing right now so much more bullish than this last time, and this is, just in case you can't see these dates, this is down here between about 2015 and 2016, when the fund outflows were decreasing here. Or, I'm sorry, fund outflows were increasing, meaning a lot of funds were putting pulling cash out of the market, and just hoarding cash, okay? So what we have here is really price was kind of heading lower with that fund outflow. But as you can see right here, during 2018, yes, price started headed lower, but we've headed higher with that staying low. So we haven't even seen a jump in fund inflows, okay? So as you can see, when there was an uptick in fund inflows, there was a big movement up in price. But we've already rebounded here in price. So imagine how much this market has left when we haven't even started to see an uptick in fund flows. And the next chart we're going to cover here is range compression. So this is the range compression here for the S&P 500. And what this means is this chart down here is the Bollinger Band width, okay? And this is on the top of the chart here, up here at about 24, is a very wide Bollinger Band, okay? That means that price is expanding huge. It goes up and down, similar to how we had over here. You can see the Bollinger Bands got big when price kind of broke out of that range and saw a big move here. Same thing over here, right here. So what we're seeing right now is a big range compression, meaning price is very, very tight. Okay, price is very, very tight, and you can see that basically every other time that has happened, it has led to higher prices. You can see right here, last time that we were very tight in that range, right here, we headed higher. You can see right here, very tight for the S&P 500, headed higher. You can see down here, another range, headed higher. This was a big dip we got super tight here for the S&P 500. This one headed lower. This time there was a super tight range here in the S&P 500. It led to higher prices. Again, right here led to higher prices. And here we are once again down here, which means we are the Bollinger Bands are very tight, which means price is very compressed. We're trading sideways here for virtually the last few months. Okay, the resistance is getting sold off, and the bounces are getting bounced at support. So we haven't really gone much of anywhere. And most of the time, as you can see on this chart here, it leads to higher prices. The next thing we're going to be covering here is the USD over JPY compared to the S&P 500. And this is a great indicator for the future direction of the price of equity markets. Okay, so as you can see on the top here, this blue chart is the dollar over Japanese yen. The bottom chart here is the S&P 500. So you can see we've got similar setups here. Right here, the last time we bounced, this is the beginning of 2018. You can see that's when we got a bounce, or I'm sorry, yeah, like March is when we started to get a bounce. Looked very similar here for the S&P 500, and you can see it led to higher prices. All right, you can see right here the dollar Japanese yen USDJPY was forming a bottom right here, and you can see that marked the bottom here for equity prices as well. And you can see the current price here, price action of the US dollar Japanese yen is looking very similar. In fact, it just recently broke over a resistance, and it looks very, very similar to the S&P 500, almost identical. All right, so that is another indicator that this market is going to head higher. So though that was the last chart that we're going to be using from Callum Thomas. Again, good follow, has some really great info. Thank you to him for providing that information. The rest of it is going to be my own research and charts. So the next thing we're going to be looking at is TLT and bonds versus the S&P 500. So this is the monthly chart for TLT and bonds, right? I'm going to point out this resistance that we have up here. We have actually a short position on TLT via some very long-term put options that is going extremely well. It's our biggest position that we have, and we got short up here near about 147. So that trade is going very well. This resistance here has led to lower prices in TLT, and each time has led to higher prices in the S&P 500. So let's take a look at these specific examples. So we have right here, this was in December of 2008, right here. All right, that first one. Let's take a look at December of 2008. All right. Right here on the S&P 500 is December 2008. It literally marked the bottom right here of the bear market that we saw that lasted pretty much the entire year of 2008. All right. The market bottomed soon after that and headed higher. So that is the first instance. We're going to look at the next one. Up here, let's see, this is about July of 2012, right? July of 2012. S&P 500, let's look. 2012, let's see, I'm going to use the crosshair. Let's see, July, right here. July of 2012, right here. As you can see, that led to higher prices in the market after that. Let's look at TLT again. Right here. This was January of 2015. January of 2015. Let's look at the market here. I'm going to move my face out of the way so you can see the dates. January 2015, right here. Okay, so virtually this was a time where we traded sideways and headed a little bit lower in this case right here. But eventually prices headed higher. We're looking at TLT again. So let's see, January 25th. Okay, this one was July of 2016. July of 2016. Let's see, July of 2016, right here. All right, you can see right here. And price ended up going on a multi-year run, as you can see right there. All right, so here we are once again, near the highs on the S&P 500, and TLT is once again getting rejected at this level here. You can see that this is 2 months into it. Okay, we're 2 months into this rejection. You can see this was August of 2019 that we hit this resistance. August of 2019. All right, you can see the S&P 500. August 2019, you can see it bottomed right here, and we headed higher. So again, this is a longer term chart. Each time we didn't just head higher for a month or two. We headed higher for many months, more than years. All right, and this is just the beginning. Okay, so that's the S&P 500 versus bonds and TLT. And the next thing we're going to cover here is the dollar. Just the dollar, not the dollar in JPY. The dollar versus the S&P 500. Let's take a look at the chart. All right, so this is UUP, and this is the dollar index fund. Okay, it tracks the dollar. So the last time, or the last several times, we came up to this resistance. As you can see right here, this is again December or November through January of 2008, 2009. Okay, we'll look at the S&P 500, and you can see again. Remember, December and January ended up marking the bottom here for the S&P 500, and we headed much higher after that. Let's take a look at the dollar chart once again, and you can see the most recent time that we hit this resistance right here was in about January of 2017. Okay, January 2017. Let's take a look at the chart. Right here. All right, so right here, January 2017, and you can see it led to much higher prices in the equity markets. All right, and here we are once again coming up to this resistance. All right, so we tried to break over this resistance, and this is the monthly chart, and then we ended up failing trading below it. All right, so this is a great sign that the dollar is behaving exactly as we thought it would. All right, so dollar is once again at this resistance and breaking below, and here we are on the S&P 500 near all-time highs, and basically every other time this has happened, the dollar has been a signal that the equity markets would head higher. So now what I want to do is I'm going to cover the charts and the price structure of some of the major stocks. I'm going to go with Google, Apple, JPMorgan, and Nike. And I'm covering these stocks because you're getting a good mix of tech, banks, and consumer goods. iPhones, and Nike is, I think, the biggest apparel company out there. And I think these are, when you put these stocks together, the market can't really move without them at this current structure. And they're a very good indicator of the current health of the market. All right, so let's take a look at Google, and then we'll work our way down to Nike. So this is the monthly chart for Google going back 20 years. It's not quite 20 years old as far as the stock is concerned, but we've got a lot of data to work with. So I'm going to go over the current price action, and then I'm going to show you other times where price action has looked very similar, and you can see the results for yourself. So as you can see right here, we've got Google has this flat top resistance. All right. You can see we're trying to peek our head over it at this current moment. We've got this nice uptrend here, and you can call this an ascending wedge, whatever you want to call it. I'm not huge on patterns, but this is a very similar structure to what we've seen in the past. I'm going to show you previously we've had very similar setup. There we are, ascending and flat top right here. Very similar. We broke over it here and then had a multi-year run. You can see right here another very similar setup. As you can see, it led to higher prices for about 6 months before consolidating once again. And then you can see over here, here's another one, trading sideways and with an ascending wedge. Boom, multi-year run right here. All right. Another time this happened was right over here. Higher prices. Here's another one. Higher prices. Okay, I can draw, this over and over again, but the point is that we've got a very similar setup here that has happened 1, 2, 3, 4, probably 5 other times, and each time it's led to higher prices. Okay, this is a continuation pattern. A lot of people talk about this market like we're in this super euphoric state, but what you don't realize is that stocks like Google have been trading sideways for virtually 2 years. All right, and it does that because it needs to rest. Okay, we had a big run, and now it needs to rest. Okay, same thing here. Had a big run, rest, run, rest. All right, it corrected through time. All right, but a euphoric market would just be, something like this, where we headed higher for, 2 years straight with virtually no pullbacks, and then it needed to pull back. Okay, same thing here. Huge move up. I mean, this was like 2.5 years, and then we needed to rest. All right, so right here we're already resting. Okay, we're already resting. All right, so that's Google. Definitely think that Google individually is set for a breakout, and I don't think the market can really correct if Google is heading to new all-time highs and breaking out for multi months and quarters and potentially multiple years. Do you? I'll leave that up to you. Okay. The next one is that we're going to cover Apple. All right. So Apple here. What we have here is a very clean structure. You can see it looks a little bit different than Google, but very similar nonetheless. Okay, so I'm going to show you other times where we've had similar setups. Okay, so you can see right here we made a high previously, and then we dipped, and a significant dip, and then we ended up breaking that high right about here. All right, and you can see we headed higher for about another year. Yeah, actually a little over a year. Okay, and notice how when we came back and corrected again, where did we bounce? Right at that high. What a coincidence. All right, so here we have again, big move up, we made a high, and then we had a little correction. Okay, then what happened when we broke this high? All right, we broke this high here, and we ended up heading higher for another a couple of years. All right. Here's another instance where we had a move higher and then a correction lower. And again, notice we came down almost to this previous high, almost to it. All right. So that's why it's really important to draw these long-term charts, because you can get some great discounted prices, guys. Okay. So we're looking at a very similar structure. Once again, we have this big move up and then a correction and then a bounce, and then just this month we broke over that high right now. So you could argue that this is the beginning of at least a multi-month move. All right, you can see right here, this was, what is this, August of 2014. You can see it peaked out over here in February of 2015. So about, what is that, like a 10-month move, something like that, a 10-month run. Over here, this was a 2-year run from here to here. So we've got a 10-month run the last time, or the first time this happened, and then a 2-year run right here. So we've got between a 10-month potentially and a 2-year run that is just about to start here for Apple. Okay, that's what we're looking at for Apple. The next one is what did I say? Is JPMorgan. And again, this is a bank stock. Okay, bank stock, and banks are pretty important to the market. Okay. All right. So move my face out of the way just a little bit. Okay. So what we have here is, oops, wrong tool, is a breakover resistance just recently right here. All right. You can clearly see flat top resistance for 2 years. And again, let me remind you, same thing I said about Google, is that does this look like a euphoric market? No, because we already had this move up and we basically traded sideways for 2 years. All right, sideways trading is not euphoric. Okay, you want to be concerned, or not concerned, but starting to, maybe trail your stops or sell part of your positions after we've had a multi-year run, something like that. But after we've been trading sideways for 2 years and then we're breaking higher, that is the time to buy. Okay, so again, let's look at some previous times where we've had a very similar setup. Here we go. Boom, right here. You can see flat top resistance. Very similar setup. All right. Here's another time. Flat top resistance. Right here. Broke over that. Here's another case. Not as clean as previously, but that's okay. Flat top resistance. Broke higher right there. All right. Very similar setups have happened 1, 2, 3 times before. I'm sure it's happened many times before that as well. Breaking over resistance, and not only that, not only are we breaking over resistance, but we did so on earnings. JPMorgan just reported earnings this week, or last week, sorry, last week. So not only did it break higher, but it broke higher on earnings, on an earnings reaction. You can I'm making a separate video sometime in the near future talking about fundamental analysis versus technical analysis, and I never look at, I don't want to say never, but the vast majority of the time, I never look at any kind of income statements or revenue or earnings numbers or anything like that. All I care about is how the market reacted to earnings, because oftentimes, because of human nature, earnings can be subjective. So I could look at an earnings statement and say, oh, it's bullish. And then you could look at the same exact numbers, the same exact earnings statement, and say, oh, it's bearish. And that's why it's subjective. But what is not subjective is price breaking over resistance on an earnings reaction. So that's why it's really easy to just keep it simple. How did the market react to the earnings, because at the end of the day, that is all that matters. Because let's say JPMorgan breaks higher and higher and higher, yet you're there thinking that JPMorgan's fundamentals and their earnings was actually bad. That's where the disconnect happens, okay? So that's why it's really important. Keep it simple. If we break out to new all-time highs on earnings, that is bullish, right? Okay, we can all agree on that. So that's JPMorgan. Next, we're going to look at Nike. All right, what a beautiful chart. And this one has been a great winner. We are currently long part of our position. We sold part of our position. We got long at 90 via some longer dated call options. We sold part of it at 95, and we're trailing our stop for the last half. But it has been a very, very nice winner. This is another one that broke over resistance right here on an earnings breakout. All right, an earnings breakout. Here's another time where we had some flat top resistance right there. Boom, broke over it. Here's another one. Resistance up here, broke over it, big run higher. Here's another one. Boom, and then broke higher. Let's see, here's another one. Broke over it right here and broke higher. All right, and you might be thinking, well, it ended up headed lower a little bit after that, but you got to remember this is a monthly chart, and this is us heading higher from about $20 all the way up to about $30. So that's a 50% gain in the stock down here. All right, here's another flat top resistance. Broke over that resistance, headed higher. What do you know? Okay, so I don't need to go over every single flat top resistance, but you're getting the point here. You can see there's 1, 2, 3, 4, 5, 6. Sure, there's many other instances here. At least 6 other instances where Nike breaking over a flat top resistance has headed higher. And again, do you think that the market can head lower with stocks like Nike, Apple, JPMorgan, and Google all breaking out? Do you think that that is possible? I'm not even going to answer that for you, but I hope that this has really made sense for you. The next thing we're going to cover is the current structure of the S&P 500 chart. I'm going to go over some bounce zones, some resistance, and give you my thoughts on that. So here is the daily chart for the S&P 500. All right, so you can clearly see we're in a very nice uptrend. It was funny because, and I like to share some comments that I get from people on StockTwits, but a person said that we're only in an uptrend if we break out to new all-time highs. That I don't know where this person is getting that from, but an uptrend is higher highs and higher lows, and that's what we are making. Higher lows, higher highs. All right. You could argue that we didn't make a higher high right here, but this is not a downtrend. Okay, this is not a downtrend. This is an uptrend until proven otherwise. All right. So we've got resistance up here, right around, let's see, right around 30.25. Okay, 30.25. So a break over 30.25 would signal to me a multi-year run here on the S&P 500. We've been trading sideways here. I've gone over the price structure of the market earlier in this from a longer-term monthly perspective. A lot of people think that that's impossible. A lot of people are not prepared for that. As I showed you with the first chart that I showed you, the fund outflows versus the price of the S&P 500. That means a lot of people are cautious and expecting something bad to happen. And most of the time, most of the people are wrong, okay? A lot of people are cautious. Okay, so 30.25, a break over that would signal a breakout, all right? Now, if we head lower, some bounce zones, the first bounce zone to me is around 29.50. There's a gap that needs to fill. Well, I should rephrase that. This gap doesn't need to fill, but if we head lower, I suspect that that gap will get filled. So that's the first level of support. All right, and if we break that, this is the ultimate buy zone down here at about 2,900, because we have this nice uptrend that we've given that has given the market a bounce each time. Okay, there, multiple times against it here, right here, and that's right around 2,900. Okay, so if we head lower, I expect a bounce at 2,900. That would make another higher low. All right. So this is the current structure of the market. Notice how it's really, really tight. Really, really tight. All right. We've got trade war, positive trade war news. We've got Brexit, positive Brexit news coming out, and all the things that I discussed in this video. So pay attention to 3025, 2950 here on the S&P 500, as well as 2900. So I hope that this video has been very helpful to you. If you don't already know, I have a private membership group here at thetradinganalyst.com where I share real-time trade alerts via text message with exact entry and exit prices. So what we're looking at right here is the Trading Analyst Portfolio Tracker. Okay, let me get my face in the video a little bit better here. Okay, so you can see that we've got a average win of over $3,000. An average loss, we do have losing trades, but they are much smaller than our average win. Our average win is double the size of our average loss here, and that is how you remain profitable in the long term. You can see we have plenty of losers here, but the winners far outnumber the winners in not only quantity but in quality. You can see just here some recent examples in the past: 58%, 66% win, 62, 84, 54, 54. Those are just a few examples. Here are the losses: 6%, 5%, 16%, 3%, 11%. So you get the picture. The winners are far greater than the losses, and we keep money management is very important to us, and that is how you protect capital, and that is how you grow an account on a consistent basis. So all of these trades here were shared with members at thetradinganalyst.com. These entries and the exits were both texted to members in real time. So if you are looking for real-time trades that's going to tell you exactly what I'm buying and when I'm buying it, then I highly suggest that you sign up and join today, because I think it can really make a difference in your account and in your growth and in your financial future. In addition to these alerts, you're also getting private member-only videos that I make exclusively for members at thetradinganalyst.com. You're also going to get a written watch list where about 90% of these trades that we alerted to members here all came from a watch list that I send out to members. So you're going to know exactly what to expect. We're not just sending you out text messages in the middle of the day hoping that you can follow along. That does happen sometimes when I see something in the middle of the day, but 90% of these trades all went on the watch list ahead of time so that you're prepared and you know what to expect, and it also is going to help you learn and grow and get better. In addition to all of that, you are getting access to our private video area where I have over 20 hours of educational content that's going to help you learn and grow and get better as a trader. So you're going to get access to all that when you sign up and join today. Most importantly, you are getting these real-time trade alerts that is going to flat out put money in your pocket. And there's a reason that I have on the website that we are the #1 trading alert service on the planet. And I mean that. We are the most profitable trading alert service on the planet. We are what other trading alert services claim to be. So if you'd like to make consistent returns on a monthly and quarterly and yearly basis, we're not just talking about a lucky day or a lucky week. We're talking about continuous profits after profits and winning trades after winning trades. Then I highly suggest that you sign up and you join today. and I'll start sending you alerts as early as you sign up. So I hope you make that decision for yourself, and I look forward to seeing you inside thetradinganalyst.com.